afternoon, I'm Jennifer Christian and I work as a portfolio specialist in the investment management team, and I'm going to provide you with a brief overview of this week's market summary. It has been a wild week for global equity markets. Equities initially rose sharply. The S&P 500 index, for example, rose 4.6% on Monday and 4.22% on Wednesday. However, most equity markets then gave up these gains as coronavirus cases continued to spread. The Fed cut US interest rates by 0.5% this week, which puts pressure on the other major central banks to follow suit. Now, this is positive, as a fresh wave of global easing will help mitigate the economic fallout from the coronavirus outbreak by relieving the pressure on households and companies. Additionally, this is unlikely to be a one-and-done cut by the Fed. In fact, we would be shocked if the Fed doesn't cut US interest rates further at their next meeting on Wednesday the 18th of March. The same can be said for the Bank of England, and we wouldn't be surprised if the Bank of England reduces UK interest rates by 0.25% or even 0.5% at their next meeting on Thursday the 26th of March, if not before. Now, while it is probably too early to say that equity markets will fully recover in the short term, as the global consumer is suffering from a crisis of confidence due to the effects of the coronavirus outbreak, but it is pleasing that the pace of new infections has slowed in China, which will hopefully help to quell the uncertainty and allow equity markets to look past any coronavirus-induced recession to a potential Q3 or Q4 2020 economic recovery. Consequently, we would like to repeat our previous statements that although we remain positive on equities over the long term, particularly those in Asia and emerging markets, with infections rising globally, there is a good chance that equity market volatility will remain elevated in the short term. As such, we are maintaining our short-term cautious stance with a slightly higher than normal level of cash. Furthermore, in our discretionary portfolios, where clients have excess exposure to companies where coronavirus risks are pronounced, we have reduced or sold some of their holdings. For example, we have reduced our holdings in Melrose Industries and Compass and sold our holdings of Carnival and Burberry, as they are likely to be hurt by lower consumer and tourist spending. We have also used this weakness as an opportunity to add to companies where their share prices are lower than they were just 2 or 3 weeks ago, such as National Grid, London Stock Exchange, Flutter and Unilever. Elsewhere, the price of a barrel of Brent oil fell nearly 10% today, after talks between OPEC and Russia to cut output in order to prop up the oil price collapsed. Consequently, a repeat of the 1980s when the price of oil collapsed is now a possibility, as Saudi Arabia and Russia are both likely to increase production at a time of slowing demand. Now, a lower oil price doesn't simply mean cheaper petrol pump prices. More importantly, oil accounts for a large proportion of the total cost to produce all sorts of everyday products from plastics, household products and clothes, not to mention the energy to produce food and metals. This lower oil price is the equivalent of a massive tax cut for all consumers and all countries that import a significant amount of crude, such as Japan, China and India. And because the lower oil price will affect so many other goods and services, it will also further dampen inflation, which is already well below the targets of most global central banks. Now, most of the economic data released this week covered a period when coronavirus was a Chinese problem, not a global one. For example, the UK PMI reading for February, while stronger than it was during 2019, slowed to very slightly from 53.3 in January to 53, due to delays to new projects from companies in Asia. Likewise, in the US, the Beige Book said the US economy expanded at a modest to moderate rate in the period to the 24th of February, while highlighting that the coronavirus outbreak was beginning to affect travel and tourism and may cause some supply chain disruptions. And while US employment also saw robust gains, with non-farm payrolls rising 273,000 during February, and in the process reducing the unemployment rate to 3.5%, again it relates to a period prior to the coronavirus outbreak. Now, virus updates aside, looking ahead to this coming week, we have an ECB monetary policy meeting, UK industrial production and monthly GDP, US CPI, and Chinese CPI and import-export data. In addition, our new Chancellor will present his budget statement on Wednesday. On a final note, we'd like to remind you that we are approaching the end of the tax year, and if you have not yet taken advantage of your ISA allowance, now's the time to act. The current limit is £20,000, and if you don't use it by the 5th of April, you will lose it. Contact us using the details found in your email to start the process. Now that's all from me this week, and don't forget, if you haven't already, you can also read a more detailed insight into matters affecting the markets in the email.